All right, today we're going to quickly talk about some of the original research and also the best articles that we highlighted on Validea's Guru Investor blog for the week of February 26, 2021. And to start, I guess I'll start by talking about the podcast we put out on Monday, and that was sort of taking a look at what transpired in the stock of GameStop and some of these other securities that have kind of been driven by a lot of the retail crowd and I guess the users on the message board Reddit. And so what we did is we walked through, we sort of started at the beginning. We, talked about some of the early retail investors that were bullish on GameStop and then how that kind of fueled itself in the Reddit message board, how someone on the message board identified that there was a huge amount of short interest. And as the stock went up, you had shorts being forced to cover. And that prompted ultimately a huge, massive short squeeze in which the stock went from whatever it was, I don't know, a couple dollars a share in March of last year. And it went all the way up to, I think on an intraday basis, maybe like over $450 a share. And we sort of just talked about, I think, what had transpired and also some of the lessons that, investors might want to sort of think about and try to learn from this experience. And interestingly enough, on the day that we're recording this, GameStop and some of these other companies are sort of flying again here. It actually started last night, mostly in the after hours. So it looks like these stocks are still getting pushed around again. And I do know there was a firm that has created sort of some technique to look at these Reddit message board, this specific Reddit message board, Wall Street Bets, and to try to identify the stocks that are being talked about the most. And I think GameStop started to tick up over the last day or two in terms of mentions on Wall Street Bets. And so you're seeing sort of, I think, the stock move to some extent because of that. So anyways, that was the gist of our podcast this week.
Yeah, I think probably a lot of the comments I make on the podcast don't age that well, but this was about the quickest my comments didn't age well ever, because I basically said on that podcast that this GameStop situation will never happen again with another stock. And then within 2 days, not only did it happen again, but it happened with GameStop. So, it's probably not likely to get where it got last time, just because the hedge funds are not short this time. And that was a big part of driving this. So, the short interest is way, way down from where it was. So you're probably not going to get thousands of % return, but it just shows how difficult this is. I mean, just within days, we think this is not going to happen again. And already we've got GameStop was up 100% yesterday. And I don't know how much it's up today, but it's already going. But it's important to understand here that we are in a different kind of market. And, we're going to be seeing some different things than we've seen in the past. I mean, we had a huge retail influx into the market after the lows, in March and April. And we really don't know, those of us that have been doing this for a while, we really don't know what the impact of this is going to be. It's easy for everyone to have an opinion on how this is going to play out, but we don't know because we've never seen anything like this before. So it's just important to take everything with a grain of salt and know we can't really say, what might happen in the future. Like I probably should have taught myself before I said the GameStop situation wouldn't happen again.
Well, no, but it's funny you say that because the CEO of Robinhood, was on with Dave Dave Portnoy?
Yes, Portnoy
from Barstool. Yeah,
yes.
Yeah. So these guys kind of jumped on, I think it was YouTube, and they were sort of having this discussion or this debate about Robinhood deciding to stop the trading in GameStop. And one of the things that, and I think the CEO of Robinhood actually said this in his testimony to Congress too, but the odds of what happened were like 1 out of 3.5 million. It's basically there hasn't even been that many trading days in history. And, and yet what happened with GameStop, it was that's so far out of the statistical probability. But like you said on the podcast, in the markets, what we don't think could ever happen could always happen. So that's probably the biggest lesson here is don't think just because you haven't seen it before, something like that can't happen. And GameStop's just one example, but you can go back in financial history and think of instances where things that you don't think could have happened, these black swan-like events, do actually take place. So it's just a good thing to always remember. In terms of your article, you wrote about blending different factors. I know you really like the image I used, which was of the mixing board. So what was that article about this week?
Yeah, you first of all, you do a good job with those images. I don't even know where you get them from, but I still have never posted one of those GIF things on Twitter. I don't even know where people get those from. So that shows how far behind the times I am. I don't know where any of this stuff comes from. But yeah, in general, what I wanted to look at is, we've been blending, we run about 45 quant models now, and they range from value to momentum to growth to everything. And we've been blending them together for a long time now. And we, obviously you make a bunch of mistakes as you're doing that, and you learn a lot. And so what I wanted to do is talk about a few of the lessons I've learned doing that over the years. And, the three major lessons were, one is recognize what is not possible. And what I mean by that is, you have to understand that no matter how you blend factors together, even if you get these two factors that are on the opposite end of the spectrum, value and momentum, you're still going to have 1 year periods where you trail the market. So what I did as an experiment in the article is I took all 45 strategies we have. I looked at any unique combination of 3 of them. And if you do the math on that, there's about 14,000 possibilities. And I just took the best one. And then I said, all right, if I had known everything in advance, if I had perfect foresight to see what would happen, could I build a portfolio that beat the market every single year? And the answer was no. That best portfolio outperformed the market about 77% of 1 year periods. So it just goes to show that no matter what you do with factors, no matter how much you blend them, you're still going to have these periods where you struggle. And then the second one was measure what matters. And that's sort of, we've talked about that in previous videos, but the idea is, instead of using advanced statistical concepts, what we've tried to do is look at people's behavior and look at what would cause bad behavior when we're blending factors together and try to reduce those things. So if I underperform over 1 year, or if I underperform over 3 years, or if I underperform over 5 years, or if I have a huge magnitude of underperformance as an investor, though all of those things are likely to make me abandon my strategy. And so when we build portfolios, we're trying to optimize on reducing the potential of those things, knowing that they all exist, as we said before, but we're trying to build portfolios that reduce the potential for those types of outcomes that would lead to bad behavior. And then the last one was make sure the end result makes sense. And what I was getting at with that is, you have to be careful that you don't, after you've gone through this process, you don't end up with, if you looked at just the past 10 years, you'd end up with a growth portfolio and a momentum portfolio and a low volatility portfolio, and you'd have no exposure to value, you'd have no exposure to quality. So it's important that when you get at the end of these processes of blending factors together, you say, what are the potential outcomes in the market going forward? And do I have exposure that could do well in each one of those outcomes? And so if you exclude value based on the past decade, you're missing a big potential outcome, the outcome of inflation or rising rates, or, that outcome you're probably not as well positioned for if you don't have that. So it's just important to look at the end result and say, does what I've come up with here, does it make sense?
Yeah, I think your point on that experiment you did with taking all of our strategies, putting them in our optimizing engine, if that's what you call it, and then looking for, the combination that works the best. It's still only, I shouldn't say only, but it underperformed the market, 30% of all 1 year rolling periods, right? That's what you were looking at?
Yeah, 23. So yeah, a lot.
Yeah, so I think what the takeaway probably for investors, and this goes back to a quote from Corey Hofstein, I heard him say at a conference once, if you see an investment strategy that has basically never underperforms the market or outperforms over every single year, especially if it's a back-tested one, there's probably something wrong with that. And what you should say to the manager, to the person putting that in front of you is, you have to test it over a longer period of time. You have to go back even further, because no strategy always works. And we certainly know that by running all the models and even like this experiment you did. So that's probably the biggest takeaway for investors. If it looks, too good to be true, it probably is.
Yeah, no, I think that's right. And, this was obviously a perfect, exercise in data mining, what I did. I mean, this is not, you can't read anything into those results, because I basically picked after the fact the best model, not knowing anything. I wouldn't have known any of that going into the 10-year period. So even doing that, even with, breaking every rule of backtesting, I still couldn't get something that outperforms every year.
What was your top article on the blog this week?
Yeah, I liked an article. There was an article called "Technology: A New Asset Class." I think was it from CFA Institute?
Yeah, well, we might not be calling this your top article, but it's something that jumped out at you.
Yeah, it's something that I thought was interesting. And this is the type of thing, it's getting to your point. This is the type of thing you see sort of as you approach market tops. Maybe is you see people redefining what asset classes are, or thinking the world is completely changed. And the first reaction is, I think it is totally true that technology is a way bigger part of our lives. In some ways, technology is not really even a sector anymore, because it spans so many different sectors. So, one of the points they made in the article, which is interesting, is I think the top 2 companies in the S&P 500 market cap wise are Apple and Microsoft right now. But when you get through the rest of the top 10, you're going to see names like Amazon, Facebook, Tesla, Google. None of those are tech stocks, as defined by the sectors now. So in some ways, it's we have to just think maybe technology is not a sector. Maybe technology is just something that's going to span across everything we do. It's just going to be part of our everyday lives. Versus because when you try to classify companies as to whether they're technology, it becomes very hard. And when you try to go out and find companies that don't utilize technology at all, you're probably not going to find any. So I think in some ways, maybe the point here is not like we need to redefine technology as an asset class, but maybe it's, technology is going to play a role in everything we do. But overall, I still think this is the type of thing you might see when we're getting towards a frothy market, because people tend to try to redefine things in a way that makes them seem more positive going forward maybe than they actually are.
Yeah, it's a good point. Like technology is pretty much being used or utilized in every industry. Now, maybe some companies use it more than others. I mean, Amazon was built on the backbone of the internet. It wouldn't exist if it wasn't the internet, but it's not considered a technology company. You have, I think, is Google and Facebook both communications? Are they labeled the communication sector? But anyways, the point is that, you think about this technology sector, but many companies are, utilizing technology significantly in their business models, even outside of those big names. And so it's almost like a concept or a layer of the business model, and not necessarily maybe a sector. I don't know. It's interesting.
And this it reminds me a little bit of that O'Shaughnessy paper they did on the 1926 to 41 period where value struggled, because what they found is, when this new technology came in, value struggled. But then after, as things wound down and value started to do better, other firms outside of what you would be considered technology started to figure out how to use the technology. And that's sort of what we're seeing right here, I think, when I was saying like everyone is using technology, so it's hard to define technology. We're starting to see firms that would be considered more old line firms starting to utilize technology. And so it makes it much more difficult to define, what is a technology company and what is not a technology company. What was your article this week?
Yeah, so it was an article that actually was from late January, so a little bit dated, but it was from James McIntosh. He's a writer for the Wall Street Journal. I like a lot of his articles because they're kind of in this sort of more investment commentary, not like just reporting. And the title of the article was, "If it looks like a bubble and swims like a bubble, ... And then he was basically he was saying, he's been reluctant to do it, but he's seeing a lot of comparisons between the dot-com bubble back in 99, 2000 to today's stock market. And I'll go through those in a minute, but what some listeners may not know about Jack and I is we actually participated with the first version of Validea in that dot-com bubble. So we were around and building the first version of Validea during that period of time. That version of Validea actually ended up failing, but that kind of set the stage for what we've been building over the last 18 years, really starting in 2003. But, I would say that from what I remember from those times, companies with no business models raising tens of millions of dollars, sort of just these stocks trading at 100 times sales or 200 times sales, or the companies that weren't making any money, or there was no outlook for them to make any money in the near term, were sort of some of the most valued companies in the market. So, you sort of start to draw, if you think about what's going on today, you start to draw some parallels to that period of time. Now, it doesn't necessarily mean that, we're in a bubble or that the market's going to like pull back tomorrow, or that sets the stage for a bear market in the near term. But it's just, I think for people that have, been through that period, it's hard not to look at some of the things going on today and say that, it does look sort of similar. So he pointed out 5 similarities between then and now. The first one was the exponential growth in the price of story stocks. So obviously stocks like Tesla, where there's a story, almost like a cult-like thing behind it, where it's kind of hard to back into their valuations, but they're becoming extremely valuable in the market. Investors are seeking them out. So that's one example. He also pointed to number two, the flood in early stage IPO back then. So you had a lot of companies going public back in 98, 99, and 2000, very early. But what you have today is these SPACs or special purpose acquisition companies, basically, that are just raising money with the intention of buying a company and bringing them public. And a lot of these companies are very, very early stage. So you're getting a lot of maybe companies that probably need more time to develop that are getting access and going public through these SPACs. Number three, and I'm not trying to, I don't know if I completely agree with him here, but, new investors who don't know what they're doing. I mean, I do think with Robinhood and sort of just more retail investors trading, there's certainly a lot of new investors. I guess what I would say is through different things I'm involved with, I've listened to a lot of these new investors, and I think a lot of them seem like they're reasonable and smart and do have a long-term time horizon, but I know that's not all new investors. But I do think there's sort of a cohort in the market of all these brand new investors that have come in and are buying and picking individual stocks. And a lot of the stocks are stocks that are some more of these story stocks. Now, these investors believe in these stories, and some of these story stocks are going to get smoked. But so anyways, you clearly have a lot more new investors sort of in the market buying individual stocks and probably playing with options too, which can be risky. And then he pointed to a couple other things. But anyways, I just thought it's good to think back and draw parallels to history. Again, history never repeats itself completely, but it rhymes. And it's just good to think about other times in the market that we've been through, we have experience in, and try to relate them to, I guess, what's happening today.
Yeah, I mean, these things are so hard to figure out because, like you said, there's tons of signs right now that we could be in a bubble. But then you look at, the top companies, the most highly weighted companies in the S&P are very expensive, but they're probably not, the Facebooks and Microsofts of the world are probably not a bubble right now. But the hardest thing for me about bubbles is you see that you're potentially in one, but there's absolutely nothing you can do about it. Because, if you think about the late 90s bubble, I mean, it looked like a bubble in like 1997, and then you got, especially in the tech type stocks, you got something like 30% a year returns for a couple of years after that. And so there's nothing you can do. I mean, you can't short a bubble. You're not going to go to cash because you're going to miss, a ton of returns. I mean, I guess you can reduce, slowly and methodically reduce the risk in your portfolio or something, but it's very, very hard to do anything in advance with these things where you can profit from them. So you see them, in retrospect, you're certainly going to look back at yourself and say, well, I should have seen this coming whenever it ends, whether it's 5 years from now or next year or whenever it is. You're going to say, I should have seen this coming. I should have done something. But the reality is, sitting where we're sitting right now, there's not really anything you can do about it. All you can do is just invest the same way you invest for the long term and understand that at some point, this thing is probably going to go south.
Yeah, I was listening to, just real quick, I was listening to Bill Smead on Meb Faber's podcast yesterday, and he kind of thinks things are very frothy, and he was drawing parallels between what happened in 99, 2000 to today. But one of the examples he gave, and I posted this on Twitter, but let me just sort of set it up, is he basically said from March 2000 through basically February of this year, Cisco has an annualized return of 62 basis points a year, including dividends. So basically over that 21-year period, the stock has essentially gone nowhere. And yet its business from the 2003-2004 period is actually up 4 times. The reason that it is that way is because in March of 2000, Cisco was trading at what hundreds and hundreds of times sales. It was one of the largest, if not the largest company in the market. And it was so incredibly overvalued. And then when that valuation corrected, you've had a very long period of Cisco stock basically dramatically underperforming the market and many other stocks. And so I posted that on Twitter, but then someone commented, yeah, but if you look at the returns of Cisco, I don't know what it was, 5 years before that, you would have been up like 10x. So he kind of got me, this guy on Twitter. I mean, all I was doing was reposting what Smead said because I found that very interesting. But this person on Twitter commented, yeah, but if you roll the performance back. So I mean, there's nothing right or wrong about it. I just think it's an interesting thing to think about. The stock had gone up so much, investors had made so much money, it probably minted millionaires along the way. But then when the valuation, when the bubble popped, it still hasn't, it's just been not a good performing stock over 21 years. So anyways, I just thought that was interesting.
Yeah, and you see it throughout these bubbles too. If you look at when we had Vitaly Katzenelson on the podcast, he talked about the Nifty 50, the late 60s, and some of the big brand names there, you had the same exact effect. Their businesses did great in the years going forward, but their stocks did nothing. And so it just shows the starting valuation, when you invest, does matter. And like you said with Cisco, if you invested at the starting valuation of 1994, you probably did pretty well. If you had started in the starting valuation of 2000, you did badly. And that's the difference between your example and someone who the person who posted on your Twitter account, is that it doesn't matter in the short term what your starting valuation is, but eventually it does matter, and you can have really good companies that do really well and you can make no money in them.
All right. So thanks, guys. Thanks for watching this weekly recap, and we'll see you next week.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. Thanks so much.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.